In June 2026, Wall Street witnessed a paradox that left retail investors completely blind. While institutional adoption of digital assets hit an all-time high, Bitcoin experienced a brutal, unexplained 13-day streak of institutional liquidations, wiping out over $4.4 billion from spot ETFs. Mainstream media blamed sticky inflation and hawkish Federal Reserve minutes. But the real culprit wasn't hidden in Washington. It was unfolding in a secure boardroom in Hawthorne, California, where Elon Musk's SpaceX was quietly initiating a historic $75 billion liquidity event. To understand how a rocket company managed to puncture the cryptocurrency market, we have to look at the state of global finance in mid-2026. The macroeconomic landscape was tense, with year-over-year CPI hovering at a stubborn 4.2%. The Federal Reserve's June meeting shattered any remaining hope for an immediate interest rate cut. Higher for longer interest rates usually mean bad news for risk assets. Yet, institutional interest in crypto had never been stronger, driven by the highly anticipated arrival of Solana and Ethereum staking ETFs. Enter the primary catalyst: SpaceX. Under the leadership of Elon Musk, the aerospace giant announced a massive secondary market tender offer, allowing insiders and early backers to sell shares at a record price, pushing the company's valuation toward a staggering $1.77 trillion. For the world's largest hedge funds and family offices, this wasn't just another investment opportunity. This was a land grab for a piece of the ultimate multiplanetary monopoly. But there was a catch. To buy into SpaceX's private allocation, these megafunds needed massive amounts of pure, unadulterated US dollar liquidity. And they needed it immediately. The liquidity squeeze began in early June. On paper, everything looked perfectly normal. Bitcoin was consolidating comfortably above $67,000, and retail sentiment was cautiously optimistic. But beneath the surface, the smart money was already plotting its exit. Institutional allocators look at assets through a single lens: opportunity cost. When a highly restricted, high-upside asset like SpaceX stock opens up a $75 billion allocation window, it creates an immediate capital rebalancing act. You don't sell your illiquid real estate, and you don't dump your core tech stocks. You go to your most liquid, highly pristine digital ATM, the newly minted Spot Bitcoin ETFs. By the second week of June, the subtle rebalancing turned into an aggressive capital flight. On-chain data began to flash heavy anomalies. Standard Chartered's leading digital asset researcher, Jeff Kendrick, was among the first to flag a strange, systemic divergence. The outflows from major spot ETFs, particularly BlackRock's IBIT and Fidelity's FBTC, weren't behaving like a typical panic sell. There was no aggressive shorting on derivative desks, and retail spot selling remained remarkably low. Instead, massive blocks of ETF shares were being redeemed for cash in an orderly, mathematical fashion day after day. Over a devastating 13-day period, a total of $4.4 billion was systematically extracted from the crypto ecosystem. As billions of dollars vanished from the ETF order books, the spot market began to buckle. This is where the structural vulnerability of the modern crypto market reveals itself. When institutional market makers redeem ETF shares for cash, they force the underlying fund managers to liquidate physical Bitcoin on the spot market. Suddenly, a massive wall of supply hit Coinbase Prime and Kraken. Bitcoin's price slipped below its critical short-term holder support level of $64,500. This trigger event forced leveraged retail traders out of their positions, causing an involuntary cascading liquidation across crypto-native platforms like Bybit, flushing out hundreds of millions of dollars in open interest within hours. The ultimate realization of this liquidity drain hit its peak right around the June FOMC decision. While the broader public was hyper-focused on Jerome Powell's macroeconomic commentary, the institutional elite had already finalized their capital rotation. The physical cash redeemed from Bitcoin ETFs was officially locked into private placement bids for the SpaceX tender offer. The market had experienced a pure, structural liquidity vacuum. Bitcoin found itself pinned down, struggling to defend the $62,000 mark, completely starved of the institutional bidding power that had propelled it to all-time highs just months prior. This entire event exposes a profound and terrifying truth about the institutionalization of cryptocurrency. For years, the crypto community begged for Wall Street to enter the space, believing that institutional capital would act as a permanent stabilizing force, a diamond-handed foundation that would drive prices up forever. But June 2026 proved the exact opposite. To Wall Street, Bitcoin is not a religious movement. It is not a decentralized revolution, and it is certainly not a permanent store of value. It is a hyper-liquid, highly efficient vehicle used to park cash until a superior, highly exclusive opportunity appears. When Elon Musk opened the gates to SpaceX, Wall Street treated Bitcoin exactly like a high-yield savings account, ruthlessly withdrawing billions of dollars to chase the stars, leaving retail investors holding the bag during a manufactured market crash. As real market participants, this structural shift teaches us a critical lesson about risk management that 99% of retail investors completely ignore. You must stop trading crypto in a vacuum. The price of Bitcoin is no longer dictated solely by on-chain metrics, halving cycles, or retail hype. It is now deeply intertwined with the liquidity needs of traditional finance. When major private equity events, sovereign debt rebalancings, or historic IPOs occur in the traditional world, crypto will act as the primary liquidity donor. True risk management means monitoring institutional capital schedules, tracking ETF redemption velocities, and realizing that when a massive private allocation window opens up elsewhere, a crypto correction is almost guaranteed. This is simply part of a repeating pattern in the maturity of any asset class. As digital assets become deeply integrated into global corporate structures, we will see more of these macro-driven liquidity rotations. It is a brutal sign that the market is growing up, and only those who understand these hidden flows will survive the volatility. Which factor do you think is the biggest threat to Bitcoin's liquidity next quarter? Let me know your thoughts in the comments below.